Let's get some of the bad news out of the way first. The typical American saves just 3.8% of their income. First-time homebuyers have fallen to a historic low. Nearly half of Gen Z works multiple jobs. Credit card debt has hit an all-time high, but it doesn't have to be this way. The 2025 recession that everyone is panicking about is your buying opportunity. I've been in the finance industry for over a decade. I've helped hundreds of clients drowning in debt, struggling, living paycheck to paycheck. The people who get rich during recessions aren't the lucky ones, they're the prepared ones. Now, you might be wondering, what makes a recession a good time to build wealth? Let me break down the mechanics. Recessions are like Black Friday for investors. Everything goes on sale. Stocks that were trading at $100 per share might drop to $60. Overpriced real estate becomes heavily reduced in price. Quality companies with huge potential get thrown out in the garbage. But the wildest part is the asset fire sale. When recessions hit, asset prices get hammered across the board. Apple doesn't become a terrible company overnight because its stock price drops 20%. A rental property in a good neighborhood doesn't become worthless because the market panics. The value is still there. The price just reflects temporary fear rather than the long-term reality. During every recession, money moves from people who panic and sell to those who stay calm and buy. From the reactive to the strategic. Now, I have a personal mentor and friend who just yesterday we were talking, and he casually mentioned that he has like 100 grand sitting in cash, waiting for the right business to buy. That is how you act in a recession. And if that sounds confusing at first, watch the rest of this video and it'll make sense. Understanding why recessions create opportunities is one thing, but actually capitalizing on them requires a specific game plan. If you learn these 4 steps well, you'll do more than just get by. You'll actually grow your wealth during tough times. Let's start with the first important step, managing your debt and your cash. Getting out of debt isn't just about saving money. It gives you freedom to make better choices. Think about it. If you are paying $800 a month for loans, you can't use that money for anything else. But once you're debt-free, you can use that money to invest, especially when prices are low. Let me explain a simple way to organize your money to pay off your debt faster and start investing more. I like to think of this in 3 layers. The first layer is emergency cash. Keep enough money in a high-yield savings account to cover 3 to 6 months of expenses. This money is like your safety net. You hope you don't need it, but it's there if you absolutely have to use it. The second layer is having credit cards with a 0 balance. Don't use these for shopping. They are just there as a backup plan. If you ever need quick access to money, you won't have to ask for others to help, and it's 30 days of free money. The third layer is for homeowners. Try to get a home equity line of credit before you actually need it. It's smart to do this when times are good. Why? Because banks are much more willing to give you money when you don't actually need it. When your finances are healthy, rather than when you're desperate. Once your finances are stable and you build a safety net, the next step is making sure that your emotions don't get in the way of your progress. During a recession, strong emotions can absolutely take over, so turn off the news. You might feel scared and want to sell all of your investments. When we're afraid, we often make the worst decisions at the worst times. That's why the key isn't trying to predict the market, it's taking your emotions out of the process. The best way to do this is through automation. Think of it like a self-driving car during bad weather. You keep making progress without letting fear control your decisions. Here's what that looks like. Set up automatic transfers to your investment accounts. Same day, same amount, every month. Use a diversified portfolio through a low-cost index fund instead of trying to pick winners. Don't pause contributions just because the market's down. That's when you're actually buying everything on sale. The goal? You keep investing without having to make decisions while your brain is in full panic mode. And I've helped hundreds of clients do stuff like this, and often I run into people that have like a Robinhood account and they've just got some play money, but it's time to step up to the big leagues, set it and forget it, and go live your best life. And by the way, your funds are gonna do a hell of a lot better this way. The best part is the automation sets you up to do the strategy called dollar cost averaging. When you invest the same amount of money each and every month, no matter what the market is doing, that is called dollar cost averaging. It means you're automatically buying more shares when prices are low and fewer shares when prices are high. During recession, the strategy is gold. When the market is down 20%, you're buying 20% more shares. When the market's down 40%, you're buying 40% more shares. With this setup, you're literally buying more when everything is cheaper automatically. Think about this for a second. Those extra shares you buy during a recession are literally building the foundation for a lifetime of wealth, because a $500 a month investment during a recession can be worth thousands of dollars 20, 30, 40 years later. If you're in your 30s, 40s, or 50s, this is a great opportunity. Theory sounds great, but let's look at some real numbers from actual recessions to see how this plays out in real life. History doesn't repeat, but it does rhyme. Let's look at the 2008 global financial crisis first. If you had $10,000 to invest in the S&P 500 in, say, March of 2009, it'd be worth over $50,000 today. That's a 400% gain from one of the worst financial disasters in history. People who bought quality real estate during the foreclosure crisis made fortunes. People who bought bank stocks when everyone thought the financial system would collapse became millionaires. Next came the 2020 COVID crash. The market dropped by nearly 34% in 5 weeks. If you invested $10,000 in March of 2020, it'd be worth nearly $20,000 today. That's almost a 100% gain in just 5 years. People who bought airline stocks, cruise stocks, and travel stocks when everyone was afraid to leave their house made incredible returns. Dollar cost averaging helps you stay consistent. But if you want to make smarter moves, you also need to understand what's moving the market. The Federal Reserve. The Federal Reserve, aka the Fed, is like the thermostat for the economy. When they turn the heat up, things move fast. When they cool it down, markets slow, spending drops, and people tighten up. One of their favorite tools is interest rates. Lower rates make it cheaper to borrow, so more people invest. Higher rates make saving look good again, and suddenly stocks aren't as exciting. They've also got other tools with fancy names like quantitative easing or quantitative tightening. Here's what that actually means. Quantitative easing, or QE, means they're adding more money into the system, which usually pushes prices up. Quantitative tightening, or QT, they're pulling money out. Prices often fall. Now, the good news is it's all public, and their plans are usually clear and posted online if you're paying attention. Most people don't, but you will, because knowing when the Fed is about to shift gears is like checking the weather before you leave your house. You can't stop the rain, but you can bring an umbrella. Now, this affects me right now because my family is looking to buy a house in the coming months, within, maybe the next 9 months. Who knows? A lot of things happening behind the scenes. But one of the things we're thinking about and would love to see happen is lowering of interest rates so that buying a home will be cheaper, right? If mortgage rates are 6%, but they dropped at 5% or 4%, that changes the game for us. So just one example of how these decisions affect us on a day-to-day basis. Can you see the recession pattern form? Every crisis creates the same predictable pattern. Fear creates massive selling pressure. Selling pressure creates bargain prices on quality assets. Bargain prices create opportunities for prepared investors. Patient investors capture those opportunities. Time turns those opportunities into wealth. The historical data proves this works. Now, let's create your personal financial action plan so that you can execute on this. Step 1, clear debt and increase liquidity. You have to eliminate all high interest debt first. This will allow you to make investments when things are not so expensive. Step 2 is automate your finances. Set up the complete flow: income, high yield savings, an emergency fund, investment accounts, bills, and finally spending money. Step 3, dollar cost averaging. Set up automatic investments from every paycheck. This will allow you to buy more when everything is cheaper. Step 4, observe the people who control the money. Knowing how the market will turn out before it happens is a huge advantage. The bottom line is the 2025 recession separates people who panic from those who profit. Your automated system will keep investing when everyone else freaks out. This is exactly how I help my clients survive recessions. Are you ready to start automating your finances? Click the link in the description below to grab your copy of my battle-tested Rogue Finance Blueprint. Also, watch my previous video on Warren Buffett's 5 golden rules for financial success to make sure that your money is not sitting around looking pretty, but actually working for you 24/7. Thanks for watching.